So there's always a trade-off between risk and return. You've always got to be thinking that the more return I'm likely to get from something, the more risk there will be associated with that. Sometimes you hear people talking about a high return investment for low risk. Never ever believe high return, low risk. If it's high return, it's high risk. If it's low return, it's likely to be low risk. And so always keep that in mind, there's always that relationship. So if you look at bonds, bonds are low risk, low return. Equities are high risk and can be high return. And obviously the risk is that they're not high return. And if you lined up all the sort of investments we can typically get in terms of their risk return profile, you get a risk return spectrum with government bonds down the bottom end, money in a term deposit next to that, and then corporate bonds are next cab off the rank in terms of low risk, low return. And up at the other end you get equities and hybrids, and even further out you get warrants and options and CFDs and derivative type of products, which are potentially very high risk and also potentially very high return. So really it's about thinking about where you want to be positioned, and in fact you don't want to have all your eggs in one basket, so you want some low risk, low return assets, particularly if you're getting older, and you want some growth assets as well. So these are defensive assets and these are growth assets. And if you look at how that actually plays out in the market, the defensive assets tend to be very low in volatility. How much do they move around? Whereas the growth assets tend to be much higher in volatility and they move around an awful lot more. So if you looked at the last 20 years since the year 2000, 17 or 18 years, the average volatility of equities was in the region of 15–16% per annum, and that's what you want. You want your equities to be volatile because that means they can go up as well as down, whereas bonds tend to be, fixed rate bonds tend to be 2–3% annualized volatility, and the floating rate bonds are in the region of 0.5% or even less volatility, and that's what you want from your defensive assets, whereas your growth assets you want them to be a lot more volatile. And equity and equity hybrids securities are in the middle, they're sort of around 7%, so hybrids are not as stable as senior bonds, they're more in the equity camp, and so you get more volatile assets and less volatile assets, and again you mix them both together in your portfolio.